All right, and we are recording. Good afternoon, gentlemen. Thank you for joining me.
Thank you for inviting us.
Thank you, Lance.
So I'd like to introduce everybody to Mark Gersel with GRG and Lewis, also with GRG. They are one of the better known and very well regarded accounting firms in Florida. And I believe you provide service throughout the entire state of Florida, correct?
Yes, we
have
do.
offices in the East Coast, West Coast, South, and North, all the way to Orlando.
Jacksonville to the Panhandle.
Fantastic. So I wanted to kind of start off with talking about the most common question we're getting right now, which is folks that are wondering, why is it taking longer for us to get an audit? We're sitting in May right now. We're getting at the end of May, going into June, and they're wondering why is that taking longer? And we're seeing that across all firms. This isn't something that's specific to GRG or specific to Southwest Florida or specific to the East Coast of Florida or Central. We're seeing this throughout all of the state of Florida right now. So
I was going to say it's an industry-wide issue, Adoni. There's a significant deficit in professionals in the industry, and that's statewide. Students are not enrolling in accounting like they used to. Obviously, there's tuition's declining, and professionals are retiring. So there's an industry-wide deficit of professionals within the specialty of the condos, HOAs, co-ops. That mixed with an increase in demands for financials as a result of increase in revenues and research and the new regulation coming out of Tallahassee, that has created this perfect storm. And the last issue is the complexity of the financials that we are now seeing most financials with multiple special assessments and insurance claims as a result of these hurricane storms. And that adds a lot of time into the audit files that we previously budgeted for X amount of time, and then we're seeing this increasing the volume of transactions and financials that double the size they used to be at the same time that we are not able to, like any other CPA practice in the state, finding sufficient professionals to go with the market.
I'd like to add, Tony, also that we do have somewhat of a remedial action plan to say, the best to prevent that or to mitigate being late is to make sure that we're communicating with emails back and forth. What are you missing? Here's the document request you sent last time. Here's what I gave you. Let me know if I'm missing. So if there's a trail back and forth, and that is much on us as it is the managers who we normally go back and ask for bids or whatever it may be, that is the best way to monitor and kind of push us along. At least it's the best way to communicate with the board what's going on and if there's any difficulties, why it's taken time. But it's the number one thing we focus on. We're aware of it. Certainly, we're doing things internally to help that, including going offshore for accounting talent. But it is an industry-wide problem.
We go to these seminars and events, and we speak to the other CPAs, and we all facing the same. And one of the main topics we all agree to is the communication management. And some people are even hoping that with the advance of AI, a portion of that communication management can be assisted with that, that weekly follow-up, that weekly update of the inventory of what has been provided, that back in the days used to take time out of the file for the professional to go through that. So some people are saying, well, with the advances of AI, they might come in the near future, that possibility that now the professional can really just take the time to audit the file instead of doing the update of the inventory of the records and follow-up of the emails back and forth with the client. So we think that with the recognition of the issue and the new tools, we really believe that we would be in a better position in the near future as far as that communication management and the inspection and the follow-up updates of what is needed to get to completion.
Donnie, again, just to reiterate, the insurance claims, the insurance proceeds, millions of dollars, flooding into the area. Our state is known for fraud and, with absentee management, millions of dollars. There's only limited quality people out there. So, some people are playing on the fringes. So it adds a burden for us we're doing an audit. We're not doing a forensic investigation, but we have to be mindful that, we don't miss something that's obvious that we should be flagging for the boards.
So, so you were talking about hurricanes, and that also is something that we're seeing a lot of is impacting them financially, both with the insurance funds that are coming in and special assessments. One of the things that we also get asked a lot by our directors is, let's say I have a budget and my budget is $310,000, and that's my budget, right? So I'm going to have $310,000 in revenue, theoretically. But a hurricane comes through and I end up with $400,000 in hurricane money that comes in. Now I'm going to have financial reporting according to that, whatever those two numbers are together. I'm not the accountant, you guys are. So I'm not allowed to add two numbers together.
Let's call it 700.
Call it 700. So at this point now, we're going to need to have an audit done instead of a review, correct?
Yes.
And that makes sense when we think about it, because that money has come into the association either way, even though it wasn't in our budget. But we are going to have to, take that into consideration. And that becomes doubly true with folks that were thinking that they were going to get a compilation done, and now they're going to have to get an audit or something. It impacts their costs. It impacts the amount of work you need to put in. Do you mind explaining a little bit the difference between a compilation, a review, and an audit?
Sure, Louis, I'll let you do that. I just want to know one thing. With the influx of the assessment and the proceeds, we don't show it as revenue, so it doesn't count towards the audit until we spend it. So if I receive it in 2024, but I don't spend it until 2025, you're not going to see it as revenue until 2025. It won't impact the audit or compilation requirement until you spend it.
Yeah, the compilation is the most basic engagement. No assurances provided in a compilation engagement. It's basically the internal financials. CPA puts that in a fund accounting format, some basic notes, and that goes back to management. Now, on a review, there is some analytical procedures and some testing, and it's part of the review process. Interview with management team, and obviously the scope is now significant since now a review does provide some assurances. On the audit, it's the highest of the level, which adds into that an increased scope of the testing, plus the review of the internal controls and confirmation with third-party vendors or financial institutions. Audit services, usually those engagements come hand-in-hand with a tax return, and I believe one of the questions was related to taxes, so we can wait and put a pin on this and then take it later on, but that initial assessment of the package provided might not provide information as far as being able to provide a tax estimate unless the whole package is provided to the CPA when the CPA is requesting the initial minimum set of financials to be able to offer a quote to the management company.
Also, an audit involves not just the numbers, but the process behind the numbers. If you have social income, are you taking in cash? Are you paying related parties? Are you paying board members? Are you paying managers? How are you using the credit cards? That whole, it's not just the numbers, but how are you producing the numbers part is an audit, which is different from a review and a compilation.
That's the part about the internal controls.
Yeah. Now, another area that we oftentimes get questions on is, what is the best way to do a special assessment? And I'm curious as to your answer, because mine's always,
The best way is not to do a special assessment.
But if you can't avoid it, as far as accounting for it, how do you account for it? And my answer has always been kind of, it depends. We see special assessments doing a couple of different things. Sometimes it's a special assessment to cover a loan. They're getting a loan from the bank, and now we're going to special assess to cover that loan, which might be over a period, hopefully not, but sometimes it's a period of 7 years, so they'll try to do a special assessment over 7 years. Sometimes it's a special assessment because we had a pipe break and we've got to replace all of this, and we're going to special assess to cover that pipe breakage, and it's going to be in and out, and it's over. And a lot of times, I guess the first question is, should we be opening another bank account for the special assessment funds, or should they be commingled in the operating account?
It's not required to have a separate bank account for the special assessment.
The next thing we're hearing a lot about, which has been recent, so interest rates have gone up, which is bad for the loans, but it's been good for folks that are making money on CDs, but we're also seeing other forms of income that are starting to hit them. We were talking about the hurricanes. We're seeing the settlements come in, and so some of those settlements are creating tax implications. depending on if there's bad faith and all of that, it gets even more exciting. And we're seeing all our associations paying taxes, and there seems to be a belief that we're not supposed to pay taxes. We don't pay taxes. So what's going on with that?
Yeah. So associations, even commercial condo associations, because Revenue Code 52A, even though most of it was intended for residential associations, commercial condo associations could also qualify if they meet the 90% or more of the expenses to maintain the association, or 85% or more of the income coming from the dues and assessments, and that there is no part of the income that can benefit any private shareholder of the corporation. So even a commercial condominium could qualify under Revenue Code 52A. So in general, condo associations can file under Revenue Code 277 or Revenue Code 52A. So if they do it on the 52A, which most of your associations do, which is the 1120H, income is split between exempt and non-exempt, and interest income from bank accounts is non-exempt. So if they go the other way, if they do an 1120 under Revenue Code 277, then the income is divided between members' income and non-members' income. And again, interest income is considered by the IRS non-members' income. So no matter what form they file, interest income is going to play out to be a taxable amount. So as the amount increases, you run out of expenses that can be used to offset the income, because you lose the connection, the basis of these expenses related to the production of that income. And then after that, you start losing the allocation of the percentage of the expense. So as the interest income increases, then you get to a point that the expenses are not enough to offset that, and then you are left with an amount that is subject to tax. On the 1120 is about 21%, on the 1120H is 30%. I have board members that are retired CEOs, CFOs, that they understand the benefit of the 1120H, even though it's a higher tax rate at 30%, they prefer to do that instead of dealing with the state of Florida, which is a factor when you do an 1120, and also because historically the 1120s, that tax return is part of the pool of the tax returns that are most subject to IRS audits. So this, is a preference by the board members to either select an 1120 or an 1120H. The selection of the age is done by just filing and submitting an age before the due date. Once that selection is done, it cannot be undue unless, petition is made to the commissioner, and only the commissioner can approve that reversal of that selection. Most commercial condominiums, and I believe that was one of the questions, even though they can do an age, they decide to do the 1120 because with 1120, they can start accumulating net operating losses for the future. That's one of the advantages of filing under Revenue Code 277. When you do the 1120 age, you have many benefits, but with that comes that you don't get to carry on with the NOLs and things like that. So it's not a right or wrong approach. If it is an existing client and there's a good relationship and the board is involved, and the board calls Mark and me and they say, hey, potentially having this commission because we're going to install a cellular tower in the association within the next 3 years, and we expect these proceeds. So we might say, well, you have been having losses that under the 1120, there's nothing to do about it, but if we expect to have this in the next 3 years, let's file an 1120 and let's start accumulating these losses. So when you have those proceeds in the future, now we have an NOL that we can apply to that. There's a lot of, tax planning, with existing clients that can be done.
Just to add to that, two things, it does get down to interest income mostly, and as interest has grown and you got insurance money sitting around for a year or two, we're earning more interest. Our rule of thumb is, and if you have other income, whether it's on a non-exempt or non-membership, you can't use those losses in social or whatever to reduce interest income. Interest income can only be reduced by things that are related to it, which is usually an allocation, maybe 10% of management, a little bit of accounting, a little bit of insurance with Fidelity, not the property, obviously, So you get down to it, if your interest income is above $10,000, $15,000 total interest income, you're going to have to worry about making estimates. If you're below that, you can offset it, and either way you file, not have to pay taxes. But if your interest income between all sources, operating, reserves, special assessment, settlement funds, all different funds, if that total interest income is going to be more than 15,000, you're going to owe some tax.
And Adoni, one thing that, we don't think that the members are really thinking about this is you might not know where you're going to file at the end of the year. If you file an age, you're not required to have those quarterly estimates. But since you don't know, there is no harm on doing quarterly estimate payments. Because, if for whatever reason you have to do an 1120 after you close the year and you didn't make those estimated tax payments, you're going to have a penalty. So there's no harm in doing that. You're going to have to pay taxes anyways if you are earning more than what the expenses can offset. So I would recommend clients to get into the quarterly estimated payments just to avoid that in case that is needed. Before closing the year, again, under the same basis that we don't know what would be the choice, because you might have a board member that might say, we're going to do an age, you have election in January, you get someone new in the board that is former CEO of Coca-Cola. He says, cash basis, big mind setting, and he wants to do an 1120. Well, what happened is, A, we didn't do the estimate. B, before closing the year, we did not make an election of Revenue Code 70-604, which helps the association to roll over the excess members' income to avoid taxation in that year. So just because of the not knowing and potential changes in the board, after closing the year, I would recommend those two things: making quarterly estimate tax payments, and at the annual meeting before closing the year, to have the members vote and have it in the meeting minutes that the membership elected to opt for that revenue code. And I can send you an email with the language and specific, so that you can send it to your managers. It's revenue code 70-604.
Two other quick points. The insurance settlements themselves are not taxable, even if we don't spend them all. They're what's called a return of capital, so that's never an issue, just the interest we earn off them. And you did have a question about co-ops. They have to file a whole different return. It's called an 1120C, and they deal again with two columns. They call them patronage and non-patronage, and instead of this revenue ruling rollover, they have what's called a qualifying dividend. So if you have a surplus in the right column, you can roll that over, but that middle column, which is the taxable one, which includes interest, you're still stuck with, only having $10,000 or $15,000 of expenses that I can allocate against, no matter what.
Well, a potential question could be, who's responsible? Who's going to tell the board that they have to make these payments, and what is the amount? Okay, so I know most associations don't have a finance committee, an investment committee. I think that the treasurer of the association would be, I want to believe that that's the person that really, dives into the financial packages on a monthly basis and is checking the variances in the P&L and is checking the bank reconciliation and that year-to-date interest income, seeing that number increasing and increasing. So I do believe that between the treasurer and the manager, with the help of the accountant, they can come up with the amount. And again, it's just an estimate. It's just to be able to show the IRS that we complied and we did these 4 payments that might not even be needed if we end up doing an age after we close the year. But just in case, we got an estimate payment every quarter in, so we are in a better position as far as making an election after closing the year, because we know we're not going to have to be dealing with the penalty.
When you're for tax returns, we've talked about several different kinds of tax, or a few different kinds of tax returns right now. What is the average cost for preparing a tax return? Because it's going to depend on the type first.
Yeah. 1120H standard pricing could be between $375 and $600. A regular 1120 could be between 6 and 2,000. Most of the ones that I see are around the 1,200, something like that. And obviously, not to say if if it is a club with significant operations and multiple cost centers and that, those 1120s can be 5,000 and up. But for the most part, the pricing that we see is around those smaller amounts.
All right, and now when they do the 1120, there's some other returns they're going to have to file as well, though, because they're going to have to deal with.
That goes within the pricing that I
That's
gave
within
you.
that price.
When a corporation elects the 1120, we also have to do the F1120 with the state of Florida. But the one point to make is, when we send extensions to the IRS and we send the extension to Florida, I have seen Florida not accepting the extension because payment was not sent with the extension after the threshold amount. I don't remember the exact amount, but I have been involved in filings that the state of Florida says, yes, you submit the extension, but there was no payment with the extension, and the amount due is in excess of X, Y, and Z, so you were late.
And what do you see usually for the price for cooperatives for that the 1120C, I think it is, right?
Similar to the 1120, around 1,000 more or less. Obviously, if they have fixed assets that are 2 pages of fixed asset, that increases the fee and things like that. Have you seen associations asking you to do the financials for them in cash basis?
Yeah, I mean, it goes both ways. I have a love-hate relationship with it because on one side, it's just so much easier to explain to people. If you're dealing with an accrual of insurance or something, well, why the money didn't leave the bank account? We didn't pay. Yes, you did. You paid it 4 months ago. Here's where it left the bank account. And they get a little, particularly, I think our industry, there has been some bad actors. There's been some bad accountants, bad management companies, bad everything, right? And you mentioned a comment that Florida's kind of known for fraud. After the hurricane came through, it became even worse. And so sometimes cash provides the clarity and simplicity that makes life so much easier.
That's why you have a separate bank account for special assessments. Same reason.
Yeah, and that's one of the reasons. So if we're doing, we were talking about the special assessment, I said it depends. So if we've got a pipe that burst and we need $30,000 to make the repair, frankly, we're not going to open another bank account. It's just easier to say, okay, we're going to special assess you $30,000 and we're going to bring it in. It's going to go out and we spent all of it and then some. Here you can see it on where it came in. Here you can see where, it came in here, it went out here, 30,000 came in, 31,500 went out, and we're good.
My answer to that is because we do see clients that not only they ask management to do it in cash basis, but when we do the audit, the same client asks the question, why the adjustment? Why couldn't you do it in cash basis? So the issue is that GAAP doesn't recognize the cash basis. It needs to be in accrual. The association might even be in violation of their own documents. You want to do cash basis because that's what they're asking. Cash basis is really easy to explain in cash out. Look at the bank, that's the transaction, we are done. Well, a lot of documents do have language explaining that the financial records of the association should be maintained following GAAP, meaning accrual basis. So now you might be facing the fact that you might even be providing a product to a client that is not in compliance with the declaration of the association. For management purposes, you can do a cash basis schedule and do it like that. Prior to closing the year, you do the accrual basis, so you show a year-end financial on accrual basis, because the CPA is going to need accrual basis to do the audit. So there's a lot that can be done in between, as long as we can explain to the members and we disclose what is needed to be disclosed, so that the readers of the financials know that these financials are in cash basis, and cash basis is not recognized on the GAAP. I would advise you to reach out to legal counsel every time an association ask you to do the financials in cash basis. I would have legal counsel check the declaration, make sure that I'm not in violation of any of the language.
Also, really, cash basis is not as accurate. If I have prepaids, people paid me a month in advance, it looks like I have money in the bank, but I may have prepaids of 30 and a fund, and a cash balance of 20. It looks like I got cash in the bank, but really that's tomorrow's money. So, my cash goes up because I don't pay bills. If I'm a couple months late, then it looks like I'm doing great. So cash is much easier to manipulate. If you pay every bill on time and everybody pays you on time, there's no real difference.
Not only that, Mark, about the associations that don't have a lot of units, the billing is done quarterly, and 10, 12% of those, come in seasonal basis. They come in November or December. They give you the maintenance for the next 2 quarters. You look at the cash, think you have a lot of cash. The board might not even adjust the upcoming budget. They think they have a lot of cash and equity.
Or I don't make my reserve transfer.
What money paid in advance for next year expenses.
I don't
There's a lot of
see
ways you
many
can build up
associations.
cash that's not really representing true increase in value.
Yeah, so I guess we don't see many associations that are pushing for the income to be in cash basis. Usually revenues there, to my knowledge, well, that's not true. There's been a small handful that have pushed so hard on the cash basis, they want pure cash basis, and
You're always right, but there's a propensity to be misled by what you're looking at because it's cash basis.
what we end up with more of is on the
Hybrid.
expense side, insurance. That will be the one that we end up the most with. So, because they're trying to monitor cash flow, and so they like to, we're going to spend 40, let's say it's a 30-unit association. The biggest thing they have in there is insurance. Comes due in March. They want to show that $50,000 going out in March.
If you do it every year, the annual expense is pretty much the same. It doesn't really matter at the end. It's not a big deal, because you're doing it every year. There's a prepaid in there every year, and it should be amortized over whatever months left over. But it shouldn't distort it if you're consistent year after year. If you didn't do it the prior year and some other management company did it a totally different way, then that 1 year is going to be all screwed up.
Yeah, on the income side, I don't think we would ever, to my knowledge, I've had no one that we've ever acquiesced to their request to making it cash basis, because we have to have a receivable. It would make our lives so difficult to handle receivables and everything else and not have it just in front of us. And then also knowing what's a prepaid and what's not a prepaid, the distortion.
What if a board member kicks back a legal bill or a construction bill and you're sitting on a lot of money, but
Yes.
you haven't paid these bills yet, people?
Yeah, so
How about if you get a stop and letter, a request, and if you don't have it in accrual and you don't have the ledger of the, with all
right,
the
and that's the reason I'm
duties
saying
and
if you
the
go on,
unpaid,
that's all on the
it's
income
kinda like
side.
a
So
challenge.
I don't think I've had anyone that we've acquiesced to that before.
Revenue, they're doing it.
On the revenue side. Usually it's on the expense side where we want to use prepaid insurance or something, and then they'll do that. And then there's actually the other side of it, even further out there. There are folks that really, really like accrual, and we are depreciating the bulk.
We don't want accruals to the day. That is so counterproductive, misleading, confusing the general ledger, time
Yes.
wasting. It's wrong.
But we have people that request it. They're like, there's both sides of the spectrum. Most of them are somewhere in the middle. Yeah, I would say maybe half of the documents talk about GAAP, half don't. And so, the half that are on GAAP, it's easy because you say, this is it, boom, we're easy. The half that aren't, you end up dealing with arguments about the FASB for reserves, because now we want reserves as an expense or something. You're like, oh, come on. And for us, I'm going to pause. We're going to edit all of this part out. But for us, a lot of it is just trying to be consistent across associations. And then when I have the one association that wants the reserve as an expense, it keeps triggering somebody who's looking at financials like, hey, how did we screw this up? We didn't. But once every 5 or 6 months.
The more time you do it just one way for one guy, it goes horribly wrong always. Because somebody else comes in ultimately and nobody can figure it out, and it looks like you're manipulating the books, and it's a disaster usually.
So, well, I appreciate your guys' time. I didn't want to take quite this much, but I really appreciate all of
you're
your
gonna
time.
handle all this, Anthony, but now comes the summer. Everybody's taking time off, but I'm back, mid-July. So if you wanna get together for one of those now in preparation for the budget, because I'm sure August, September you're gonna be drowning in budgets. If you wanna do a training with the staff, and let me know. I'll go sit with you guys. Whatever time is needed. Informal, bring in some snack piece or whatever and sit with you guys.
Sirs,
Financials as a live ammunition example in the meeting to keep it interactive, alive, to go through best budget practices.
I appreciate that. I will probably be taking you up on that. So thank you.
Absolutely.
all right, guys.
All right. Thank
Thanks a
you.
lot. Bye.
Bye.